Hello everyone and welcome back to another video. We're talking stocks. We are talking your favorite topic, ladies and gentlemen. It's exchange traded funds, aka ETFs. They're just like regular funds, but they trade like regular stocks. So they are baskets of stocks, hundreds or thousands, and you can buy and sell them on the open market just like a stock. And they have become very, very popular over the last 10-15 years, and they are all the rage right now, seeing hundreds of billions and trillions of dollars in inflows over the years. And a lot of investors have seen this opportunity to not have to pick their own stocks and just go with ETFs. And among the ETFs, there is one king and one king only, and that is the S&P 500 ETF. Now, this of course is the ETF tracking the Standards & Poor's 500, which contains the 500 largest companies in the US, sorted by market cap, and it is the go-to index for the stock market. Now, the three candidates we have are the three only pure blood S&P 500 ETFs. Now, keep in mind there might be other ETFs with S&P 500 in the name, but they might be called S&P 500 Growth, Value, Dividend, the smaller companies, whatever, or where they just pick out specific companies within the S&P 500, or it might be an S&P 500 short, which is betting on the S&P 500 going down. So these are the three main plays, and they rank number 1, number 2, and 3, I believe, amongst the ETFs in the world by assets under management. So these are the 3 largest ETFs in the world. And I did a video a while back where I tried to attack this question, but I'm here to squash the beef once and for all and find out which ETF is the king of kings when it comes to investing. Now, today's candidates are State Street's SPY, Vanguards VOO, and iShares IVV. Now, I'm going to look at a couple of different things. I'm going to at least look at expense ratio, dividend yield and yield history, inflows and outflows, assets under management, and overall ratings. Now, keep in mind the differences are going to be small, almost insignificant. But we all want to place our money in the very best investment. So I'm going to look at all of the tiny little dirty details and try to find out which one of these three is the best ETF. And this is truly an ETF where you can put all your money in one place, click buy, and never have to worry again. Now, keep in mind that the numbers I go through in this video have and will change. So these numbers are the way they are as of April 2020. In 2 years from now, they're going to be completely different. And some of the ETFs also might be able to be traded commission-free. So you can buy and sell without paying the transaction fee on certain platforms. So do make sure, check with your broker if you can buy any of these ETFs commission-free, which means the small transaction fee you have to pay every time you click buy or sell. And if you can, you should probably go with that ETF, because the difference between paying $5 and having no transaction fee can become a huge difference in the long term. Now, I also think I should quickly go through the numbers that I'm going to evaluate the ETFs based on. So we have, first off, expense ratio, which is the amounts of money or percentage you have to pay of your entire holding every year to the ETF provider. So if the expense ratio is 0.05, you have to pay 0.05 of your entire holding every year until it changes, which it does. But it usually goes lower because the companies can offer better and better services and lower expense ratio. The dividend yield is a completely regular yield. And now the mechanics are a bit different than from a company, because an ETF holds many companies, but the dividend is paid completely normal and it's calculated as usual. So a 2.5% dividend means 2.5% of your entire holding every year until it changes, which it usually does. It can go up or down depending on what the market does, but when the market goes down, the yield usually goes up and vice versa. Inflows and outflows is really how much money is going in and out of these funds. The dividend yield history is going to be a chart of where the dividend yield has been historically, and we can see whether it's been stable or unstable. The overall ratings are just ratings of the fund done by third parties, where concentration means how many stocks they have compared to the S&P 500. Liquidity means how much is traded, how easily are they to buy and sell shares of. Expense ratio is how low the expense ratio go. Yield is how high the yield is, and so on. So the numbers are quite self-explanatory, but I just thought I should mention them before we get going. First contestant out of the gate is going to be IVV from iShares. This is the second largest ETF in the world by assets under management. It has an expense ratio of 0.04, which is great, and it has a dividend yield of 2.88%. These are great numbers, not just for S&P 500, but for ETFs in general. Now, it has seen a stable stream of inflow, and it has seen $5.5 billion come in 2020 alone. Now, as far as score goes, it scores A on liquidity, expense ratio, and dividend, scores a B in volatility, and B minus in both concentration and performance. So the rating, again, it's all A's and B's, but we're talking small differences here, but the rating is overall great. Now, moving on to an ETF from our all favorite provider, Vanguard. It is ticker symbol VOO, the third largest on the list by assets under management. It offers a 0.03 expense ratio, which is great, and it's one of the cheapest ETFs out there, and it offers 2.29% yield, so a little bit less than IVV, but keep in mind dividend yield does vary very massively over time. Now, it has seen an incredible streak of inflow, seeing $22.3 billion injected in 2020 year to date alone. So it is probably the ETF in the world that has seen the biggest inflow. All the ratings I could find was an A on liquidity and A on expense ratio. If you want to see more overall ratings, you actually have to pay, which I'm obviously not going to. But VOO, a great pick. Now, on to our last contestants, and the question, does size really make all? Because we're moving over to the King of Kings, the largest ETF in the world, State Street Corporation's SPY, also known as the Spider. This is the world's largest ETF, offering an expense ratio of 0.09 and a dividend yield of 2.30%, so barely eking out a victory over Vanguard there. The world's largest ETF has actually become quite a bit smaller, seeing a big outflow of money and seeing $14.5 billion vanish so far in 2020 alone. So it might not stay on the throne for that much longer. Now, to overall scores, it scores an A+ in liquidity, being the largest and most traded ETF in the world, A in expense ratio, B+ in performance and concentration, and B- in volatility, and an A- in dividend. So overall scores, nothing to take away from it there. That was quite fast and furious. There you have the numbers. Now, they all win in different categories, and you might be wondering what numbers are the most important. Well, it's expense ratio and dividend yield and history. The reason for this is it has an actual dollar impact on your investments, and a tiny difference in expense ratio or dividend yield over time can accumulate into a huge loss or potential gain. And there's examples out there where you can see that the difference between a 0.1% expense ratio and a 1.5 expense ratio can account for as much as 20, 30, 40, 50% of your total return, depending on how long you stretch the calculation out. So over 30, 40, 50 years. So a small difference can really make a huge difference dollar-wise over many years. But, you know, IVV wins out big on dividend, obviously, but its yield history has been choppy waters at best. And it was all the way down at 0.4% for a quarter in 2016 and one recently in 2019, I believe, while Vanguard and SPY have shown much more stable yield history. So don't be fooled by the yield for IVV right now. And as recently as October 2019, VOO and IVV had the same yield. They were neck and neck. And that's been the case for most of the time. But dividend do vary quite a lot. The expense ratio is a bit more stable, but it is just as important as dividend yield. And the difference in expense ratio is going to be the equivalent of a difference in yield, because a dividend yield is calculated by your total holding, and so is the expense ratio. So the numbers are actually going to be equivalent. So a 0.05 difference in expense ratio is going to equal a 0.05% difference in yield. But my trophy is going to have to go with Vanguard's VOO. It was quite close between IVV and Vanguard. SPY doesn't offer much. It has seen big outflow. It has just as low dividend yield as Vanguard. Its yield history is good, but not as good as Vanguard's, and it is the most expensive. So there's no way I would go with SPY. Now, it doesn't really matter if you go with IVV or VOO, but the expense ratio of Vanguard tells you that the company is a little bit better when it comes to ETF offering. And if anything, I think Vanguard is going to lower the expense ratio before iShares. And the expense ratio will probably stay lower, almost, for always for Vanguard. While the dividend yield is a bit all over the place. So I think what you lose in dividend for this quarter, you will make back in decades if you go with VOO. So that's that. If there is one ETF where you can put all your money, never look at it again, and sleep well, it is VOO, but the other ones are great alternatives as well. So hope you finally got your answer. Let me know which one of those you're holding in the comment section below, and I'll see you in my next video.